Hello everyone, Douglas here, Kenner Market Analysis, and today I want to discuss deficits and the ever-ballooning, ever-expanding U.S. federal debt. Try and figure out how much it actually matters, or maybe better put, what is the impact it should have on the trading and investment decisions you and I are making. So if you like this video, make sure you hit the subscribe button, click that notification bell, and give me a thumbs up at the end of this update. So anyway, fiscal year 2018 came to a completion at the end of September, and headlines started popping up regarding the massive expansion of the federal debt over the last fiscal year, and the $1 trillion+ added to the debt. And many deficit hawks and fiscally conservative pundits began ringing alarm bells. That if we're not careful, we are on the verge of becoming Venezuela, Turkey, Argentina, or Greece. So here are just a couple of those headlines that came up. What I'm really worried about is federal debt, why we should control the federal debt before the next recession, so on and so forth. Threatens the current economic boom. We're going to be up to 30 trillion before you know it. Congressman sounding the alarm. Anyway, you get the idea that this number going up is a bad thing, or has some bad potential impacts on the overall economy. So the obvious question is there any merit to these concerns? Could the U.S. really end up like Argentina, Venezuela, or Greece? And what is the toll on the economy from such a large deficit? Well, if you watch my interest rate video that I posted earlier this week, you'll probably have an idea of where I might be going with this, so it might be worth checking that out. These are kind of two tangent ideas coming together. But to set the stage a bit here, from my interaction with many traders, those in finance or economics, I think the budget deficit, that is the U.S. federal debt, is probably the most misunderstood number in all of finance and economics. And because of this, understanding how the economy functions, with the primary purpose of how to invest in trade based on economic data points, it can become very confusing if you kind of get this number wrong. So if we can get what the deficit is, how it functions, and what its impact is on the broader economy, especially kind of from a growth perspective, you'll be at a huge advantage, or we'll be at a huge advantage over the majority of the market. And of equal importance, we can have confidence that the trades and the positions we have are at least positioned properly and in the right direction. So I really think the biggest myth, in terms of just helping us understand this, I really think the biggest myth regarding the federal debt is that it is a number showing how much the U.S. owes someone. Okay, so that's, in my opinion, the biggest myth. That it's a number that shows how much the U.S. owes someone. And this, of course, is intuitive, right? Because if you or I are in debt, it would be how much we owe someone else who holds the opposite side of that debt. However, there's one big difference between us, between me and you, or some company or large corporation, and that is that we are all currency users. In other words, we're all working, making things, doing things to get money for whatever purpose that may be, whereas the government is the currency issuer. It's issuing the currency to get people and companies to do something for it. So we work to get the money. The government, issues the money to get people to work. Understanding this concept is very important here, and we'll keep expanding on this. Okay, so before I move any further, though, I do need to throw out a bit of a caveat here, some qualifiers here, as I push onward. I'm not advocating that this is the right way for a nation to function monetarily, or the best way, or even the worst way. It's not what I'm getting at here. It is, however, the way how things actually work. And my goal as a trader, as an investor, as someone who seeks to quantitatively study the markets and make decisions based on the highest probability outcomes, is to understand the data, what the data is showing, and what the significance is, or impact will be, of any point on the broader market. Look, frivolous government spending can have obvious real effects on the economy, and it's going to divert real resources to wasteful endeavors. I'm not denying that at all, but what we're looking at is capital flows, and where that capital is flowing, and then what the best trade is, what the best position is to capitalize from that. And that's what we're doing here. Okay, so this isn't a political commentary. This is a finance, econ, discussion here and what the impact is ultimately on us being on the right side of any given trade. So that other way, another way to kind of think of this to help us kind of get back into wrapping our minds around this idea is that, and listen closely, there would be no money in the U.S. case, there's no dollars in existence unless the Treasury spent them into existence in the first place. Spending has to logically precede money, or better put, debt has to logically precede money. It may seem counterintuitive, but as we kind of think this through, it's actually not. As an example, oftentimes, people think the U.S. has to kind of borrow money first, right, by issuing bonds, and then they get to spend it. But if you bring it back kind of logically to the very first dollar, right, the very first step, how could the U.S. have ever borrowed it if it never created it in the first place? Hopefully that kind of frames this in the right way. So a question that will usually come up here is like, what about a country like China, right? It has massive treasury holding, massive debt holding in the U.S. Don't we owe them money? And didn't they borrow money from us? From us to them? And the answer is no. We've never borrowed a dime from China. Now, granted, we do owe China the interest payments on the treasury they hold, and at the end, the principal down the line. But they never lent us anything for those bonds. They acquired those bonds because they sold us, the U.S., goods and services, and first received dollar payments for those goods and services. And then they asked the Federal Reserve to convert those dollars that they obtained by selling us stuff into interest-bearing bonds. That's all a bond is. It's just a dollar that bears interest. This process is really no different than you or I making some sort of income that gets deposited into a checking account at a bank, and then going up to the bank and asking them to move it into an interest-bearing savings account, right? So you have a non-interest-bearing checking account, move that money into an interest-bearing savings account. All dollars, one is just interest-bearing, the other is not. Same thing with treasuries. Most importantly, you first had to acquire the dollars to get the treasuries, not the other way around. All right, so hopefully that's kind of making sense. We'll continue to kind of make more sense of this in just a second. But let's try and tie this into the markets, and I think this might help flesh this idea out some more here. So what I'm going to do now is I'm going to bring up a chart of what's known, or what's called sectoral balances, right? And this is the blue line here is going to be a net private borrowing, or really savings in this case. And the green line is, the red line, and the opposite of that is going to be net government borrowing. And then the green line is a current account balance, or effectively the trade surplus or a deficit. And what this is saying is it's saying that if the government is going into debt, that is, it's growing its deficit as it did into 2009, or as we're seeing right now, that by definition, that is an accounting identity, the private sector has to be increasing its savings, right? Or its income, if you will. So government debt is private sector income, okay? And then there's kind of the one addition here too, that current account. So again, the trade deficit or surplus is net financial assets either coming into the country or leaving the country. So if you are running a trade deficit, you are buying more into your country. That means financial assets are leaving your country. Flip that upside down. If you're a net exporter, income is coming into your country. So add all these three up, they have to equal zero, right? There's no other way around that. And again, that is an accounting identity. And so kind of the big takeaway, at least for now, is capital flowing from the government sector ends up in the private sector as savings or income. Okay. So the next question, of course, or kind of a common question or a logical step from here is if the government deficit is shrinking, like it did as we got into the government surplus into right before 2000, or as we came very close again before 2007 here, if that's the case, then how does the private sector grow at all? Well, it needs to go into deficit itself. and this would just be creating private debt. And this environment creates many bubbles. We saw this obviously leading into 2000 and into 2008, and creates a very volatile growth circumstance. And that's how you're gonna do that. But the kind of the impact of private debt expansion and its impact in that whole discussion is probably best suited for another video for another time. Definitely get into that later. But the big takeaway is if the government isn't creating the income, isn't creating the savings for the private sector, it's going to do that by going into deficit by itself through private debt expansion. Okay. But do notice that in this chart, particularly 2000 and 2008, and 2015 for that matter, kind of less to that extent, all the lowering deficits, all had lowering deficits, right? So in other words, we got into surplus here, the deficit was lowering here in 2008, and again we started to into 2015, which we had a little bit of sell-off there. We saw a very similar thing. Now, real quick, some of you are going to ask, what happened here? My understanding is this is a misprint, although I'm surprised it hasn't been updated. I heard, again, I tried to verify that this was a misprint. NIPA is the one who gives these numbers to the FRED database here, the St. Louis FRED. The other idea is that, and again, I haven't been able to find this anywhere, is that this could have just been, I don't want to say an accounting error, but an accounting impact of the repatriation at the end of 2017. But at the end of the day, this was obviously real quickly turned back around, and is not an example of a time where we went into government surplus. So yeah, if I ever find out an answer, I'll make sure and post in the comment section or something like that. But anyway, the point is that each time we went into surplus, we ultimately went into a period of growth contraction, if you will, right? And that's just because a very simple capital flow situation. So looking at this chart alone, kind of knowing what we know about what came of the markets and with this chart, right, we would suspect that something clearly was going to happen in 2000 and 2008. And again, maybe a little bit in 2015, right, based just on this chart alone. And we're able to make that conclusion because we know that when the government spends, it boosts growth because it's creating this environment that is naturally good for equities, right? We know that the best time and most of our lifetimes to ever get into equities was in 2009, when after a massive budgetary expansion, right? I mean, that is when growth is going to start to happen. So with that being said, the flip side of that would be that a shrinking deficit is truly a liquidity drain, far more impactful than QT or rising interest rates could really ever be. So yeah, to kind of bring this all together, larger budget deficits are not necessarily or implicitly bad for markets. In fact, they usually create the best situations, the best environments for market growth. Now, there are many other factors that go into calculating the health of the economy for a market, and a growing budget deficit doesn't automatically mean that equities are going to rise. But understanding that a growing deficit is what a growing deficit is, and what it's not, that is not some doomsday scenario just waiting to happen, will help you better position yourself and orient yourself to the most likely market outcomes and market conditions. So that kind of wraps up what to make of the budget deficit. If you have any questions, leave those in the comment section below. Love to answer them. I know this is a relatively short video covering a pretty big topic, so we can definitely go on this some more at a later date. Anyway, if you do like this update and you're an active trader, maybe you're a fund manager, you work in some sort of family office, something like that, or just a sophisticated investor, make sure you check out my Patreon page. I post multiple updates there each week, covering kind of both the technical side, using the wave, and the macro side, providing analysis very similar to what I just laid out here on multiple, maybe even hundreds of data points. Really cover everything. Again, kind of for that active trader, we look at a lot more granular level. And I post my every trade I make. I post. You can see my portfolio at all time over there as well. So if you kind of want to see what's going on, make sure you hop on over there, patreon.com/CanadaMA. Love to see you sign up over there. Anyway, in the meantime, like I said, if you got any questions, leave them in the comment section below. Do my best to answer those. So until next time, everyone, good trading, and we'll see you then. Bye bye.